Today, we're zoning in on just one name, NVTS Semiconductor, ticker NVTS. And for good reason. It just had a truly disruptive day. We're looking at an 8.00% surge. It closed strong at $9.05, and it did it with some real conviction. For a while now, NVTS has felt stuck, But a move this sharp, it forces you to take another look.
So the mission for this deep dive is pretty clear, and it comes right from the analysis you sent over. Is this just a one-day pop? Or is this the real start of a massive run into the double digits? Could this be that hidden gem of 2026? Okay, let's unpack this. Well, when you see a stock that's been quiet for so long suddenly explode like this, you have to look at two things. First, there's the technical picture. I mean, something on the chart changed. Big money decided it was time to get in. And second, there has to be a fundamental catalyst. The story around the company must have shifted. From move to stick, you really need both of those to line up.
Okay, so let's start where the analysis does, the technicals. Because this was not a random fluctuation, the report really focuses on the gap up. NVTS opened at $8.69, which was way above the previous close of $8.38.
And that might just sound like 31 cents, but in terms of what it signals, it's huge. It just screams conviction. Buyers were willing to pay a premium before the market even officially opened. That suggests institutional orders, big blocks being placed pre-market. They weren't waiting around.
Right, they were setting the tone. And then what the report called the no-fade stability, that was key. Because usually after a gap up, you see some profit taking, right? The stock drifts back down.
Absolutely. The quick flipper traders sell into that strength, but that didn't happen here. It dipped for, a moment, down to $8.52, and then it just held.
Yeah.
And then started grinding higher all day.
That's sustained buying. That tells a different story.
It really does. It's the difference between, say, a flash of excitement and a calculated accumulation of shares. If the buyers were weak, that gap would have filled instantly. Instead, it did the opposite. It marched straight up and closed right at the high of the day, $9.05.
And that strong close is the big technical signal, isn't it? The report calls it a bullish engulfing signal.
It is. And it's not just the shape of that daily candle on the chart. It's the context.
What do you mean?
I mean, this stock has been going sideways for months. So a signal like this isn't just a minor blip. It's basically an announcement. It's saying that period of waiting, of consolidation, is over.
And the buyers were still active right into the bell.
They were, to use the report's word, hungry. They wanted to hold those shares overnight, which implies they think there's more to come.
So the chart is screaming that the big money thinks a new trend has started. But, a stock doesn't just run on charts alone. There has to be a story, a real reason. Why now? Why this sudden interest in NVTS?
And that's where this gets really interesting. This is where we connect the dots to, the biggest theme on Wall Street right now, AI. The report boils the whole catalyst down to a single word, power.
Okay, power. Everyone's focused on NVIDIA and AMD, the brains of AI.
Exactly. But they're forgetting about the massive side effect of all that computing power.
The energy consumption.
An incredible energy consumption. These new AI data centers are just power hogs.
And all that power creates a ton of heat.
A ton of heat. And that's the bottleneck. The old silicon chips that manage all that electricity. They're just not efficient enough. They waste too much energy as heat.
So as you pack more AI processors into a rack, the whole system could literally melt down.
Or at least become ridiculously expensive to cool. And that's the problem NVTS is built to solve.
With their gallium nitride tech. GaN.
Precisely. GaN is what's known as a wide bandgap semiconductor. And in simple terms, it means their chips can handle way higher voltages and temperatures much more efficiently than old silicon.
So less wasted energy, less heat.
A lot less, which allows you to build much denser, more powerful, and more efficient data centers. It's not just a nice to have, it's becoming a necessity for AI to scale.
Okay, so this is where the pivot comes in. The analysis says NVTS is pivoting hard.
Yes. They're moving aggressively away from their old business, which was mostly, cheap mobile phone chargers, low margin stuff. And they're going straight for the high performance markets, AI data centers and EVs.
So the market is finally seeing them not as a phone accessory company, but as a core infrastructure play for AI.
It's the classic picks and shovels story. If you believe in the AI gold rush, you also have to own the companies that supply the tools to make it happen. Power is a critical tool.
And this is a long-term story. The report mentioned investors are pricing in a 2027 hockey stick growth curve.
They are, which is, that's also where the risk comes in.
Yeah.
The enthusiasm in the charts has to be balanced against the reality of today's financials. And that brings us to what the analysis calls the transition valley.
I like that term. It implies a difficult journey.
And it is. It's difficult by design. Because they're killing off that old low-margin business, the current numbers look ugly.
Revenue is down year over year.
Right. And they're burning cash. They have to invest in R&D and secure these new contracts for the AI and EV pivot.
Yeah.
They're crossing a financial desert to get to 2027.
Okay, but a skeptic would ask, why NVTS? What about competitors? There's silicon carbide, other GaN players. Is this transition valley worth the risk?
That's the key non-financial risk. Absolutely. The analysis suggests NVTS has some key IP and design wins, especially for the kind of power systems AI data centers need. But you're right. Any major delay, any big competitor swooping in, that would completely derail the story.
The timeline is everything then, which is why their cash position is so critical. The report notes they have over $150 million in cash.
And that's not just a buffer. That is their runway. That's how they survive this transition without having to go back to the market for more money.
So the whole investment thesis right now is not about this quarter's earnings.
Not at all. It's a bet on the revenue explosion they expect in late 2026 and into 2027. That $150 million is the time they've bought themselves to make the pivot work.
Which puts that 8% pop in a new light. It's the market starting to believe they can actually cross that valley before the runway runs out.
I think that's exactly it. The technical move is a vote of confidence in the long-term story.
So with the $9 level broken, what's the next target? Where are the bulls aiming now?
The next major hurdle is that big psychological number, $10.
The double-digit mark.
Everyone watches that. If it can clear $10 and, more importantly, hold above it for a few days, that's a huge confirmation.
And if it does clear 10,
then the analysis suggests the path opens up for a move toward the old highs, up near $13.
Wow. Reclaiming that level would mean the market fully buys into the new AI story.
It would be a complete re-rating of the company, a definitive confirmation.
Okay, so let's wrap this up. The final verdict from the analysis. This is not a safe, slow growth kind of stock.
Absolutely not. The report is very clear. This is a high-risk, high-reward play. It's for believers in the long-term AI and EV themes. You have to be willing to look past the ugly financials today because, in a way, that's part of the story. The chart just tells you that smart money is starting to place its bets now.
So for you listening, what does this all mean? We've really hit on 3 crucial points from the analysis. First, the technicals are strong. This looks like institutional buying, not a one-day fluke. Second, the pivot to AI and EV power systems is a fundamental game changer for how you value this company. And third, the whole thing rests on their ability to navigate this transition valley using that $150 million in cash.
It really presents you with a choice. Are you willing to take on the risk of their current cash burn for the potential reward of that massive growth curve in 2027? It's a bet on execution.
And that leads perfectly to our final thought for you to take away. The report was so specific about that $150 million runway to get them to late 2026. So think about this. When does the market's patience run out? At what point does that cash pile stop looking like a safety net and start looking like a countdown clock if those big contracts don't materialize?
That's the question. Can management deliver on the vision before the market starts pricing in the risk that they might not make it across the desert?
The next few quarters are everything. A perfect point to end on. Thanks for